Global markets, technology, and trade may be reshaped for years as the world's second-largest economy teeters on the brink. According to recent developments, China is facing its worst manufacturing downturn in over a decade, mounting debt pressures, and a short pause in its economic struggle with the U.S. These developments could impact global supply chains, investment flows, and geopolitics beyond Beijing. October delivered concerning news from China's industrial region. The National Bureau of Statistics reported that the Manufacturing Purchasing Managers' Index, or PMI, decreased to 49 from 49.8 in September, marking a seventh straight month of decline. This stretch, the longest since 2016, shows China's manufacturing are struggling more than ever. Official data are always interpreted, but the trend is clear. Beijing's decades-old economic impetus is eroding as production and domestic demand stall. While manufacturing is stressed, services and consumption rebounded, with the non-manufacturing PMI rising to 50.1. Extended national holidays boosted expenditure and service activity. The bigger picture is troubling. As production and demand fell, industrial output fell, and economists expect China's growth rate, estimated to remain around 5% this year, to slow to its lowest since the epidemic of 2022. Domestic consumption, a key economic indicator, remains sluggish. China may be facing internal and foreign challenges as pre-tariff stockpile export gains fade. Beijing has committed to boost manufacturing, technology, and consumption over the next 5 years, but slowing growth has made this difficult. Chinese macro leverage surged to 302.3% in the third quarter, up 1.9 percentage points from the previous quarter, according to the National Institute for Finance and Development, adding to economic distress. While household debt fell, poor nominal GDP growth kept it up, showing that China's economic growth is increasingly debt-fueled rather than consumption-driven. In the first 3 quarters of 2025, macro leverage increased by 11.6 percentage points, surpassing 2024's overall gain. A persistent problem is highlighted by this tendency. Sluggish growth and low inflation make managing China's growing debt load more difficult. A closer look at the sectoral breakdown is startling. For a second quarter, households leveraged, with the leverage ratio falling to 60.4% and total debt falling by 0.1%, the first quarterly reduction since 1995. This decrease indicates weak consumer confidence amid a prolonged property collapse that has devastated household wealth. Government leverage rose 2.2 percentage points to 67.5% as authorities absorbed more official debt to cover local government liabilities. Corporate leverage rose to 174.4%, mostly from state-owned companies and local government finance vehicles, increasing government-related debt. These numbers show that private entities' borrowing appetite remains inadequate despite official support, hindering growth efforts. Third quarter nominal GDP growth was 3.7%, the smallest since 2023. The GDP deflator has been negative for 10 quarters, indicating deflationary pressures. Falling prices, housing values, and household wealth are hurting consumption and investment. Analysts advise authorities to stabilize asset values, boost market sentiment, and explore easing property purchase limits or creating a real estate stability trust fund to help struggling developers. Beijing's economy is bleak even with such efforts. China's fundamental weaknesses are becoming harder to handle as growth slows and debt rises. Beijing faces a difficult foreign landscape amid internal economic turmoil. After meeting in South Korea, former U.S. President Donald Trump and Chinese General Secretary Xi Jinping temporarily paused their economic battle. The handshake and grins implied warmth and diplomacy, but the truth is more guarded. The one-year truce does not settle the core U.S. China economic issues. It only delays future escalation while providing a little respite. Under the accord, the U.S. will drop the special duty on Chinese goods from 20% to 10%, lowering the average rate on Chinese imports to 47%. Though significant, this reduction falls short of the originally threatened 157%. Beijing will resume big soybean purchases, cooperate on opioid chemical regulations, and lift rare earth export limits for 1 year in exchange. Experts emphasize this arrangement is temporary. Former Trade Representative Robert Lighthizer called the agreement a one-year truce, not a structural change, as the underlying concerns remain unresolved and renegotiation is expected when the truce expires. Rare earths remain sensitive. Semiconductors and renewable energy systems depend on these minerals. The U.S. and allies have a year to boost output and reduce Chinese imports. Scott Kennedy of the Center for Strategic and International Studies noted China's advantage as rare earth producers convinced Washington to ease export rules for thousands of Chinese enterprises. He said Beijing's global leadership and temporary relaxation boost China's economy. Peace benefits both sides politically. Trump maintained TikTok in the U.S. to attract youth and bought soybeans to placate Midwestern farmers. The White House supported Taiwan but limited AI chips to protect U.S. tech. Markets remain tranquil. U.S. market futures were flat and China's CSI 300 index slid 0.8%, casting doubt on the truce's ability to fix underlying flaws. Strategic isolation beats reconciliation during loosening. Both nations lessen dependence while maintaining trade. Trump visits Japan and South Korea for rare earth, shipbuilding, and industrial growth. China is aggressively developing semiconductor and AI self-sufficiency and exploring new global south markets. Analysts say the two economies are creating autonomous ecosystems to prevent conflict. China's manufacturing hubs were cautiously enthusiastic after the tariff cut. Exporters improved but were cautious. Numerous companies are diversifying output beyond China to avoid trade concerns. Shenzhen toy firm transferred production to Vietnam to avoid order cancellations without supplier variety. The Jiang province Christmas ornament maker is building a Cambodian plant to diversify risk. These steps show oneness. Chinese suppliers and companies cannot serve all U.S. buyers. Diversification matters. Economic data is lacking in China. Manufacturing weakness, mounting debt, and falling GDP create structural problems. Industrial output, consumer spending, and property markets remain poor. U.S. China geopolitics and domestic economic worries may prolong uncertainty and limit China's global ambitions. Only temporarily have trade tensions paused. Analysts say neither country will cease the U.S. China rivalry. Rethinking strategy. China promotes innovation, technological autonomy, and market variety, whereas the U.S. expands industrial capacity and supply networks. A truce delays the strategic conflict, which will escalate. Business and investor responses are fine. Companies with considerable China exposure are diversifying faster as global markets watch China's economy amid mounting debt and dwindling industrial output. Beijing leaders have severe choices. Stabilizing asset values, raising consumption, and aiding the property sector are important, but economic structural difficulties may limit short-term solutions. Low nominal growth and rising debt hamper stimulus sustainability. A thing is clear following the Trump-Xi summit. Economic confrontation between U.S. and China has grown. Low tariffs and trade restrictions provide short-term stability. Both powers gain strategic advantages, reduce reliance, and build long-term economies. Beijing must face internal economic slowdown, rising debt, and global strategic rivalry that will affect policy and economic performance in the next months and years. Now China's leaders must balance. A brief truce lowers outside pressure. However, the internal economy is struggling. Rising debt, declining consumer confidence, and slowing manufacturing indicate an unstable economy. World economy and U.S. China's strategic competition will be affected by Chinese responses.